Hey, it's Linus here. In today's video, I'll be sharing with you my Dhandho Investor Summary and how you can achieve low risk, high returns using the Dhandho Investor formula. When it comes to returns in the stock market or anything in life in general, many people believe that low risk equal low returns and high risk equal high returns. But that is not true, because with the right knowledge, skill and experience, we can identify low risk, high returns bets. And I'll be showing you exactly how you can do that in this video using the Dhandho Investor formula. Before we start, I'd like to take some time to talk about this point because I believe many people have this misconception about risk. They believe that low risk equal no risk. But that is not true. Low risk doesn't mean there's no risk involved. Every investment that you make in the stock market, regardless of how prepared you are and the skill that you possess, always will have a probability of a loss. And it applies to even the best investors and traders out in the world. We can be equipped with the best knowledge and skill and experience in the stock market, but there will always be risk in the stock market. But the good thing is, when it comes to the stock market, with low risk, we can still achieve high returns. All we need to do is invest when the odds are in our favor. And that is what I'm going to share with you in today's video. The Dhandho Investor formula is based on this principle. Heads I win, tails I don't lose much. So what this means is that for every investment or trade that we take, we want to minimize our risk while maximizing the returns. So when you win a lot, and when you lose a little. And if you keep making this kind of bets, you can accumulate wealth very quickly. And that is what the Dhandho Investor formula is based on. There are 9 steps to the Dhandho Investor formula. The first is focus on buying an existing business. The second, buy simple businesses in industries with an ultra slow rate of change. The third, buy distressed business in distressed industries. Fourth, buy businesses with a durable competitive advantage or a moat. And the fifth is bet heavily when the odds are overwhelmingly in your favor. The sixth is focus on arbitrage. The seventh is buy businesses at big discounts to their underlying intrinsic value. The eighth is look for low risk, high uncertainty businesses. And the ninth step is it's better to be a copycat than an innovator. Now we'll be going through these 9 steps individually in greater detail. The first step in the Dhandho Investor formula is focus on buying existing businesses. So buy an existing business with a well-defined business model. Mohnish Pabrai, the author of the Dhandho Investor book, says that we should buy a business with a well-defined business model. So a business model that we understand and is very clear to us. And on top of that, you want to buy businesses with a long history of operations. In this way, by understanding the business model of the company and by studying the long history of operations of the company, we are better able to project how the company is likely to do in the future. For me, when it comes to looking at existing businesses, I want to see that a company has at least 3 years of history of operations. The second step is look into buying simple businesses with slow rate of change. For Mohnish Pabrai, he sees change as the enemy of investments. He tends to look for mundane products that everyone needs or industries with minimal long-term change. And one such industry that he highlighted was the funeral business. The funeral business is a simple business with slow rate of change. If you compare funeral businesses now versus a couple of decades ago, not much has changed. Funeral business are mundane products and services that everyone needs. Right, so when someone dies, most likely that person is going to get a funeral. And not to be morbid over here, all of us are going to die in the future. So the funeral business is a mundane product and service that everyone needs. And the business also fulfills the criteria of minimal long-term change. So that's the second step in the Dhandho Investor formula. The third step is buy distressed businesses in distressed industries. And for Mohnish Pabrai, he believes that the entrance strategy is more important than the exit strategy. But for me, I believe that the exit strategy is actually more important than the entrance strategy, because we can enter our position at the right time. However, if we do not know when to sell our position, we can still incur a loss at the end of the day. Because at the end of the day, whether we make a profit or loss on our position, it is dependent on when we sell our positions. And that is why selling is so important. But there are many ways to skin a cat. So for Mohnish Pabrai, he believed that the entrance strategy is more important than the exit strategy, because he believes that buying in these conditions, uncertain near-term prospects, will allow the investor to get in at very cheap prices. When both the industry and the individual business is in distressed conditions, this usually means that the stock price of these companies tend to be very cheap. And that is also when Mohnish Pabrai believes that it is a good time to enter into that stock. And there's this famous quote by Warren Buffett. He mentions that be fearful when others are greedy and be greedy when others are fearful. So when both the business and the industry is in distressed conditions, what do you think are the sentiments of the majority? people are most likely to be fearful, right? So Warren Buffett tells us that we should be greedy when others are fearful. And that is also what Mohnish Pabrai believes in. He believes that the best time to buy is when a business near-term future prospects are uncertain. Because usually at those times, there will be steep discounts to the price of those businesses relative to their intrinsic value. The fourth step in the Dhandho Investor formula is buy businesses with a moat. And there are a lot of golden nuggets packed in this quote by Mohnish Pabrai. He says that the key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage. So he tells us that we shouldn't focus on how much that particular industry is going to affect society or how much that industry is likely to grow in the future, but rather we should focus on the competitive advantage of an individual company and, more importantly, the durability of that competitive advantage that that company possesses. So two things to look out for. The first is the competitive advantage of that particular company or the moat that the company has. The second is the durability of that moat. So we want to invest in companies which have a competitive advantage and whose competitive advantage is likely to be durable. The fifth step is bet heavily when the odds are in your favor. And Mohnish Pabrai gave an example of when the odds are in our favor. He gave this example. The first is 1 in 2 chance of winning or a 50% win rate. And the second is a 3-to-1 risk-reward ratio. So what these two things means is that for the first thing, out of every 10 trades, we have a chance of winning 5 out of 10 trades. And the second thing is that every time we win, we are winning 3 times the amount that we are losing. So when we have such odds when we are investing, Mohnish Pabrai believes that this is a mispriced bet. And this is when we should bet heavily on. And when the odds are not in your favor, which is most of the time, either do nothing or play small bet, such that when a situation where the odds are overwhelmingly in your favor, you can act decisively and place a large bet then. And this is also another thing that I learned from Mohnish Pabrai. When a situation arises where the odds are heavily in your favor, this is the time where we want to take outsized bets and bet heavily on. The sixth step is focus on arbitrage. The arbitrage in the stock market happens when a business has a moat and when that business sells at a price lower than its intrinsic value. Because when you can buy a business with a good competitive advantage at a price lower than its intrinsic value, it is almost certain that you can make money on those positions. And that is why there is an arbitrage. The seventh step is buy businesses at discounts to their intrinsic value. We want to have the purchase price so attractive that even a mediocre sale gives good results. So say the intrinsic value of a stock is $150. If we bought that stock at $50, and even if we sold that stock at a mediocre value compared to its intrinsic value, say $100, the fact that we bought at a price that is so low means that we can still make money in the end. So when we are looking to invest and buy positions in a stock, we want to buy with a huge margin of safety. Because this huge margin of safety can give us a lot of leeway when we are selling our stock. So we don't have to sell the stock at an extremely high value or even at its intrinsic value. As long as the stock moves somewhere close to its intrinsic value, with the huge margin of safety when we first bought the stock, we can still make a lot of money in the end. And there are two benefits when we buy businesses at a huge discount to their intrinsic value. The first is that the bigger the discount to intrinsic value, the lower the risk. And the second thing is that the bigger the discount to intrinsic value, the higher the return. So remember at the start of the video how we mentioned that we can achieve low risk, high returns in the stock market? This is exactly how you can achieve that kind of returns. With the huge margin of safety and huge discounts to intrinsic value, this lowers our risk and increases our returns. So the seventh step in the Dhandho Investor formula is buy businesses at discounts to their intrinsic value. The eighth step is to look for low risk, high uncertainty businesses. In this case, risk does not equal to uncertainty. And the reason why Mohnish Pabrai wants us to buy low-risk, high-uncertainty businesses is because low-risk plus high uncertainty leads to severely depressed prices. The low risk will entail low downsides, which means that if we bought our positions in a particular stock, low risk means that there's a very low probability of us losing a lot of money on that position. And usually high uncertainty in a business means that the near-term outlook for a business is not very clear. So there's a lot of uncertainty in the business and the industry. And the way we can deal with this high uncertainty is by conservatively handicapping the range of possible outcomes. And we can achieve this limited range of possible outcomes by doing our due diligence and research in that particular stock or industry. So if we do our own research, even though the future for those businesses may seem uncertain, we are at least better able to prepare for those outcomes. And that is why the 8th step in the Dhandho Investor formula is to look for low-risk, high-uncertainty businesses. The 9th step is to look for businesses which are good copycats rather than innovators. Because by lifting and scaling, it carries far lower risk and decent to great rewards. And remember, one of the principles of the Dhandho Investor Formula is low risk. As much as possible, we want to lower and minimize our risk in the stock market. And for this particular step, by modeling what already works, this can reduce the risk that a company takes. If you see some of the biggest and most profitable businesses in the world right now, these businesses may be innovative at one point in time. However, if you take a look at the things that they are currently doing right now, these businesses are more like copycats rather than innovators. Just take a look at companies such as Microsoft and Apple. They can't be considered innovative right now. But the fact that they are still doing better than ever right now is because of their ability to live and scale what already works. And that is the nice step in the Dhandho Investor Formula. So if you incorporate all of these nice steps of the Dhandho Investor Formula when you are investing in the stock market, I strongly believe that it can help you achieve low risk, high returns in the stock market. If you learned something from this video, do smash that like button because it will really help the channel grow and allow me to produce more content such as this. And if you haven't already subscribed to this channel, make sure you subscribe to my channel because each week I release new videos about investing, trading, and the stock market. I'll see you in those other videos. To your financial success.